Morning everyone. Thanks for joining our November breakfast briefing session. Today we're joined by Carol Harvey from UK Export Finance. Carol was actually at the Manufacturing and Supply Chain exhibition last week, so I think this is a good chance for us all to catch up if we never made it there last week, on a bit about our organisation and how we can tap into that support. So Carol is the Export Finance Manager covering the Scotland region. So I'll just pass you over to Carol because we don't have much time this morning and Carol can just take you through.
Right, thanks, Amy. Good morning, everyone. Thanks very much for joining. I work for UK Export Finance, and Amy, if you want to move to the next slide. The mission statement for the department is to advance prosperity by ensuring no viable UK export fails for lack of finance or insurance, and obviously doing that sustainably and at no net cost to the taxpayer. And we're one of the very few government agencies that actually gives Treasury money. For those of you who don't know who we are, next slide please, Amy. UK Export Finance is the world's first export credit agency. We were established in 1919 following World War I. And the purpose of the department was to try and help UK PLC regenerate itself after a devastating war. We work with lots of stakeholders. Our sister agency is the Department for Business and Trade, although we are a separate agency, as Treasury requires a line of sight as to how much we've committed the government to. We share the same ministers, however. We work with a lot of private lenders, credit insurers, etc. We're not allowed to compete with the private market, but complement, and therefore try and aim to fill in a gap. And there's three strands to what we actually do. We have insurance policies, we have buyer finance, and we have working capital products. Next slide, please, Amy. So the three strands on the buyer finance side, now I will only deal with this very limitedly. This is where we try and encourage overseas buyers and our governments to purchase UK goods and services. And by ways of doing that, they might be seeking medium to long-term finance to finance a project. But maybe, for instance, lending could be very expensive in their own country, and export credit agency backed finance is very attractive in terms of interest rates, etc. So there are various products there, but I won't dwell on them because we don't have the time, but I'm more than happy to speak to anyone later on. On the exporter side, this is where we actually are providing support for exporters. Again, we are not a bank, but we provide guarantees to banks to allow them to support their customers. And we do that through our bond support scheme, working capital schemes, and we have other products there like the general export facility, which I will talk about again later on. On the insurance side, we have a couple of products. I will say the bond insurance policy, probably you're lucky if 5 have been done in about the last 10, 15 years. It's one of those products that's just, there isn't a big take up on. But on the export insurance side, if a company is looking to protect themselves against non-payment, they could have maybe approached the private market, and they might, for example, not want to underwrite any risk in a particular country, and therefore an exporter is able to come to us on that. I've got, so the next slide, please, Amy. So on the export insurance policy, as I said, that's against covering against non-payment by the buyer. It could be for a commercial risk, or it could be for a political event that occurs. We can potentially cover up to 95% of the contract value. We do not provide whole turnover policy, and we're not allowed to insure EU and certain rich OECD countries. So we're probably there for the higher risk markets, maybe more than anything. So it tends to be single risk insurance. Now, an exporter can contact us directly, or they can come through a specialist credit insurance broker that has signed up to our products. I've got a case study for you, which is the next slide, Amy. This is a company who had got an order in Poland, and they weren't sure. It was the first entry into that market. They didn't know, and they wanted to belt and brace themselves. They tried to get cover from the private market, but it wasn't available. Approached ourselves, and we were able to give them a single risk policy to cover them against non-payment. And for that company, it helped them do that contract. They wouldn't have taken the contract without that insurance being in place. Next slide, please. We've got legacy products, and this is where they are contract-specific products. So the bond support scheme is where companies have a bonding requirement, and they approach the bank, and they are seeking a bond to be issued. Now, the bank is going to say, yep, no problem, happy to issue the bond. No, go borrow your head, ain't helping you. Or, we can help you, we want to help you, but we can only do that with a guarantee from UK Export Finance. So we can provide a guarantee of up to 80% to the bank to provide that bond to the exporter. Now, we ourselves don't have any minimums or maximums, the banks do. So I will caveat that in that sense. What it means is quite often when businesses are seeking bonds, banks will want to cash back the bonds. So that's taking up working capital. With their guarantee in place, the bank does not need to cash back, certainly to the degree of our guarantee, the value of that bond. It is available through participating banks. And as I say, we can cover any type of bond. This is contract specific, so therefore we would look at UK content, we'd look at the actual contract itself. And I have a case study for this as well for you to try and put it in context. First Subsea is a company up in Aberdeenshire, and they were transitioning away from oil and gas into renewables, and they'd won a substantial contracts. But as many may know, particularly in the renewable sector, the bonding requirement is very high, and they couldn't afford to cash back the bonds that were required. So working with the bank Virgin Money, we were able to provide a guarantee of 80% to the bank to allow them to provide First Subsea with their bonds. Now, this business has continued to grow, and indeed since then we have continued to support them, not only for bond support scheme, but also in one of the other facilities, which I will come on to. Next slide, please. The Export Working Capital Scheme is also a contract-specific scheme, and that's where a company might get an unusually large contract. They will approach the bank to get a working capital loan to usually fund the pre-shipment element of the contract. And the bank again will either say, yep, no problem, no, go borrow your head, or yes, we will do it if we can get the support of UK Export Finance. And again, we will provide a guarantee of up to 80% to the bank, which would allow them to provide the working capital loan for that particular contract. Again, I've got a case study for that. IROB is an automation, so I can't even say the word, it's too early in the morning. They're robotics and automation specialists, and they had secured a high value contract with Jaguar Land Rover to provide facilities for their new vehicle models. And they really required working capital to help fund that before they started getting paid by Jaguar, and approached the bank. Barclays weren't able to provide them on their own, and therefore approached us, and we provided them with a working capital guarantee to allow them to fund that contract. But also it was during COVID, and COVID-19 had impacted on their project timelines, and there was delays in them getting payments. So they had a working capital crunch again in terms of that. Next slide, please. Now, one of the newer products that came out, which has been a bit of a game changer for us, is the General Export Facility. And as it says in the tin, it is a general facility. And this facility is not contract specific. It can be used for bond support. It can be used for working capital. It can be used for import letters of credit. It can even be used for capex expenditure, and which is quite a game changer. So again, we provide a guarantee to the participating banks of up to 80%. The maximum repayment terms for the working capital loans and in bonds is 5 years. If your bonding requirement was going to go beyond 5 years, you would have to use the bond support scheme, for example, which is contract specific. And as I say, it's quite flexible. It's allowed, the banks love it because it saves them a lot of time. And I've got a case study on this one. Now, Circular Group design and manufacture things for aggregates and construction, etc., and waste recycling. And they required support because they were expanding into new markets, and they had to get working capital, and also they had a bonding requirement. And so to enable that business to grow, they needed a facility. So with their bank HSBC, we were able to provide them with a general export facility, which allowed them to fulfill those contracts, take on the contracts in the first place, and as well. Now, what I will say about the general export facility, and indeed the other products, the participating banks have got delegated authority, and depending on the bank, they can have delegated authority of either up to 5 million or 10 million per exporter. If every box is ticked, the bank is able to apply through our portal and give an immediate decision to their customer. So it's a lot speedier and easier to actually facilitate. One of our other newer products is the Export Development Guarantee. Both the General Export Facility and Export Development Guarantee have only been in existence for just over 2.5 years. So this is stuff that was developed during COVID and was put in place during COVID. So unfortunately, we didn't get a day off, that's for sure. And but it's made a difference. Now, the Export Development Guarantee is there for businesses to access high value loans for working capital. It is a working capital facility, not bonding. We can support the banks with up to 80% guarantee again. And there is lots of flavours to the Export Development Guarantee. You could be an existing exporter, but you're looking to maybe retool your business because you're transitioning in from oil and gas maybe into renewables, and therefore you've got working capital and capex expenditure required to maybe upgrade your facilities, and that is something that we can do. Or you could be an overseas business, or indeed a UK business, looking to invest in the UK and maybe set up a plant. But the whole plan is that you're planning to export, because there has to be an export drive to this. Again, the guarantee is available for up to 5 years, but we recognise that in the clean and green space, it takes longer for money to start coming in, and therefore we can extend the lifespan of our guarantee. It's certainly up to 10 years, and in some cases maybe more. I've got a case study on the Export Development Guarantee. Now, JDR Cables, who many companies may be aware of, they do sub-sea cabling, and they had they were planning to retool, and they needed to actually unlock and improve their facilities at their plant in Northumberland. And we supported their bank by providing a guarantee for £100 million working capital loan to fund that construction. And that in turn, of course, created local jobs and made a big difference. And we have continued to support JDR over the years in various things. We've done bond support for them, we've done working capital support for them, but this was specific for them trying to transition into the clean growth area. I mentioned buyer finance products, and this is where we are trying to encourage UK PLC to bring in business from overseas. We want companies and countries to come to the UK and buy our goods and services. We're quite sector agnostic, and it has lots of different products in there. But the purpose of it is that an exporter might see an opportunity in a country and say, we really want to get into that project, but the buyer is saying, we'd love to buy your product. However, we can't afford to pay for it in normal standard commercial terms. We're looking for medium to long-term repayment plan on that. And so therefore, it tends to be the exporter that comes to us, but depending on the country, it could also be the Ministry of Finance in a certain market. But quite often an exporter will come to us, present us with a situation, we will assess it. If we are able to, we are then able to provide a guarantee of up to 85% to the lending bank. And as I said, we're not a bank, so we usually have to have a bank in place to administer the actual funding. We would expect the overseas buyer to put a 15% down payment down on the UK exporter on signing of contract, and then we guarantee the 85% to the lending bank. Now, the UK exporter will be paid as if it's a normal cash contract, but the buyer might have anything from 2 to 5 to 10 years, depending on the value and or the product involved, to actually repay. Now, I have a case study here, and it's not a typical case study. I just wanted to show and demonstrate the indirect support and benefit that comes from us supporting buyer finance. BHC is a company in Midlothian. They are steel fabricator, etc. And they had attended one of our supplier fairs, and Contractor Construction were an EPC contractor who had won the contract to do the procurement and everything to supply for the Kumasi market in Ghana. So BHC attended that, and as a result of that, they got a chance to meet the procurement people, meet the end users, and won a £20 million export contract on the back of that supplier fair. Now, we didn't support BHC directly, but indirectly, they were able to actually win that contract. And since then, BHC have been involved in more than one contract in that. And it certainly has made a difference for that business. And, you know, I know that they certainly found the benefit of it. So they haven't had a need for our support in terms of bond support or working capital, but they did indirectly win that contract. In UK Export Finance, there is a network of export finance managers. There's roughly about 25 of us across the UK. There are 2 of us in Scotland, and we are there to try and guide, advise, signpost as best we can. If we can't help a company, we will try and see if we can signpost that business to someone who may be able to provide a solution. So we don't just say, no, we can't help you and put the phone down. We will try our best working with the likes of Scottish Enterprise, SDI, Department for Business and Trade, and the banks to try and see if we can assist a business as best we can. Last slide, I think we are now. As I said, there are 2 of us in Scotland, so I cover Fife, Central Belt and Scottish borders. My colleague Lara McGrath covers Highlands and Islands, Aberdeenshire and Teesside, and she also has Scotland-wide remit on the clean growth and renewables part of the business. I know it was a very quick snapshot of what we do, but I hope it's given you a flavour. Both Lara and my contact details are there, and I know that Amy and the team are planning to circulate the slides to members. And if anyone has any queries or questions, then feel free to contact either myself or Lara, and we will do our best to help you. Thank you.
Thank you very much, Carol. Does anyone have any questions that's logged in at the moment? No, well, Carol, just one quick one from me, if you don't mind. When you're speaking about the banks, is it specific banks that you partnership with, or is it, you know, if we've got a member who's looking to tap into this support, is it any bank that they're currently banking with that you could work with?
No, well, there are a pool of banks that have signed up to our product. So you could take all the mainstream banks. So you've got your Barclays, HSBC, RBS NatWest, Lloyds Bank of Scotland, Santander, Virgin Money. There are other banks involved, like Emirates Bank, etc., which are not going to feature much in Scotland, I would imagine. We are trying to onboard more banks. We have a non-banking financial institution that's also joined, a company called Newable, and they're very much focused on the more micro SME level, because it's very, very difficult for SMEs to access finance because banks have got their own rules and we have no influence in changing that.
No, great, thank you. That's very interesting, especially about the SMEs. Have we got any other questions this morning? No, so I think if we've got no questions, that closes us for today.
Well,
But as I say, if you think of any questions afterwards, Carol and our colleagues' information, as well as us, we're available, and you can get in touch afterwards.
Right, thank you, everyone.
Thank
Have a good
you.
day. Bye.
Thank you.